trend line. Now, when the market's in a downtrend, our counter trend line is going to look like a green uptrend line. Okay? So there's an indicator that's used in the active zone scalper that when we're in a downtrend, the counter trend line is going to look like a green line. Okay? Now, when we're in an uptrend, see that T3 Tilson's an automated trend line, so it's going to stay the same. It's still going to be a blue uptrend line. But we're in an uptrend, what we're going to be looking for our counter trend line is we're going to be looking for a red counter trend line. And that's going to be our signal to buy when the market breaks through that red counter trend line and then changes to green. All right. The way that you can draw this out is if you think about a crown, or let's just say to think about the market being in an uptrend. Okay? Let's say this was our ABCD. Right? So I draw my trend line on that ABCD. Like that. And then every time the market pushes in the AB boundary or to the C to D extension, those are going to be our green lines on the indicator. We should see a green line on the indicator at that point in time. Let me cut this off for a second. And then when the market starts to retrace, every time the market starts to retrace, we're going to see a red line on the indicator. And then when the market changes from red to green, that's going to be our signal that it's changing into the extension or the push zone. You got it? Now, when the market reverses, and pulls back all the way down to take out this previous level. All right, comes all the way down and take out the previous level. Just like in a crown, that's going to be our new AB boundary. Okay? Then, when the market starts to pull back, the green line is now going to be the retracement line. It's no longer going to be the extension line. And then when the market starts to fall again, right here, let's say when it starts to fall again, that's going to be the right tip of our crown. And that's going to be all the confirmation that we need to draw our new downtrend line. Now, here's what's interesting about this. When we draw trend lines, we usually base trend lines off the lowest low and the highest high. Now, when we're looking at reversal patterns like a king's crown, this line over here is not necessarily a trend line. Okay? It's a resistance line because we're reversing from an uptrend to a downtrend, so it's just a potential resistance line. But the idea here is this. If the market is going to invalidate this crown, it's got to break through that line. And if it breaks through that line, then we know that the market's no longer finishing the downtrend. So we need to see the market breaking through that line back to the south. And then what we want to see is a crown over here at the right tip of this larger crown. All right? And then the market pushes. If the market pushes down here, notice here's the distincting point. All right? Here's where the market's divided. When we're in an uptrend, the market's above the blue line, and we're going to look to take the green to red transition. That's going to be our highest probability trade, okay? Because we're taking the push zone trade. We're trading in the direction of the trend. When we're in a downtrend, the market is going to be below the blue line, And we're going to look to take the green to red transition, because that's going to be our signal of the push zone of the downtrend. Does that make sense? Okay, so let's look at the indicators now. Oh, let me Okay, so if you look at our same chart, pound Australian dollar, we have our blue line here, which is our trend line. We're going to use this as our guide. All right. If the market's below this line, chances are it's going to be bearish. Okay, we're going to look for selling opportunities. Ideally, we'd want to look for selling opportunities. If the market's above this line, we want to look for buying opportunities. Okay? All right. What else you'll see on here? The green and red lines. So remember, just like I said before, when we're in a downtrend, just draw that across there. The red line is going to be our push. The green line is going to be our retracement. Market's pulling back. And the market begins its push again. Got it? All right, so let's take a look at the chart. We'll start with this morning. You can see that this morning we had this red box on here, which represents the active zone. You can see if I click on this candle, that's 2 a.m. Eastern time. And you'll see that this candle over here is going to represent 11:55 a.m. Eastern time, which at the close of that candle would be 12 p.m. Eastern time at the end of the active zone. Okay, so the red boxes on my chart represent the active zone. Just so you guys can see the active zone displayed on a chart. All right, so what we want to see is that at the beginning of the active zone today, for example, today was Wednesday, right? Yeah, today's Wednesday, so it should have been a trending day. At the beginning of the zone, at 2 a.m., it's a Frankfurt open. We see that the market had a bearish signal. The market was above the outer trend line, but the signal was bearish. Okay, if I just took this trade at face value the way it is right now, I'm risking quite a bit because I don't have agreement between my red line and my blue line. Okay, I want to see the market above the blue line, and then I want to see the indicator green. Because when I see that happening, then I'm going to look and take a high probability trade. Does that make sense? So, in the automation, if you guys are automating the system, the automation is going to just try to take every trade that it can in the zone. It's going to look for the market to, or for this signal. When this line's red, it's going to take a sell trade. When this line's green, it's going to look to take a buy trade. Now, the reason it does that, let me show you. Let me pull up that chart again. Charting, open chart. Let me explain a little something about crowns and reversal patterns so you guys understand this. Everything in trading exists on a scale. This is my dissertation. This is what I keep coming back to over and over again. And this scale is aggressive to conservative. All right? If I am an aggressive trader, I'm looking to get in as early as possible at the best possible price. Okay? So when I see what I'm going to be doing is, as an aggressive trader, whenever I see this thing turning green here, I'm going to be looking to buy. Okay? And I'll buy that all the way up to the D target, and that's going to become my new AB boundary. And then when the indicator turns red, I'm going to look to sell this thing down to form C. And when it forms C, the indicator is going to turn green, and then I'm going to look to buy it all the way up to D. Then the indicator is going to turn red, and then I'm going to look to sell it all the way down to C. Now, if it goes down and takes out my A, it's okay. I'm selling all the way down to here. Then it turns green, looking to buy it all the way back up. Turns red, looking to sell all the way down. That's what an aggressive trader does. An aggressive trader is looking to take every little swing in the market, take advantage of these little swings in the meantime here. Conservative traders, just one second, guys. Sorry, my little girl wants to listen in on the lesson too, apparently. Aggressive traders are going to look to take every one of these little swings. Conservative traders are only going to look to trade in the direction of the trend. That's why when you guys first take the UTP, that's what we teach you. We teach you to trade from C to D. We don't teach you to trade B to C moves. We teach you to trade C to D moves. You use candlestick formations, counter trendline breaks, stochastic RSI U-turns, previous resistance to act as future support at Fibonacci levels. All of those things help you identify where your C is, so that way you can trade from C to the respective D target. Right? That's what we teach in the UTP. Aggressive traders, and those that have attended the mastery class, they take this kind of trade from the previous C to D move, and they'll try to take this D back to a 382 trade, where they try to trade it back to a 382. Now, watch what happens. If I take this trade, and I take this long trade, I get out of the trade at my D target, I start to trade this back. If I get out in the 382, I'm still conservative. I'm good. I'm getting out of the trade. Even though it's an aggressive trading strategy, I'm still conservative because I'm not trying to trade down below the 382. The reason that we teach the 382 is because down here below the 382, this is where the C forms. And when C forms, it usually looks a little something like this, right? Bearish decision candle, where the market is just clearly bearish, all day bearish, like that. And then the next candle is a bullish engulfing candle. Or something of the sort, where you have a, I could talk all day about this, like a morning star, or you'll have a piercing line, or tweezer bottoms, or a bullish shooting star, or any one of those things. So all that work you did below the 382 gets taken away in one candle. Now the whole point of this, the whole reason I bring this up, is because look at our next swing, right? If I were trading the C to D on the next swing and I get out at my D target, I'm good. But then if I'm an aggressive trader and I'm trading back down to the 382, I'm okay. But if I'm an aggressive trader trading down past the 382, trying to get advantage of all this, I get this entire swing. If I'm a conservative trader, let's just say I'm getting out at the 382, I'm not trading any of this move right here. I'm actually missing the large portion of this move, right? I'm missing this move. You guys understand that? And that's okay. As a conservative trader, I'm sacrificing the initial portion of the move, but the reason I'm sacrificing it is because I'm looking for the better entry back here at the backside of the trend line, at the right tip of a crown. Okay? Because I want to sell highs in the sell zone of this blue uptrend line. If I'm not in the sell zone, I have no interest in selling in the buy zone. And if I am going to sell in the buy zone, I'm going to take a very conservative target. So when we get into the sell zone, your highest probability trades are going to be the ones where you are trading in the direction of your trend, when you have a convergence or a confirmation between both the indicators. Now, originally this strategy was put together as a manual trading strategy, and then we're putting together automation for it. And the first automation I put together for this system was really for the aggressive strategy. And so I'm actually building a new improved automation for the strategy now that's going to take conservative targets when it's counter trend trading, and then still take those full targets when it's trend trading. I have it running on a VPS now, so I'm forward testing it. Once I get it done, I'll make it available to all of you.